Ever wonder why even smart investors hit roadblocks? Do you want to avoid the money traps Buffett warns about? In this video, we'll explore 12 common investing mistakes and show you how to dodge them like a pro. These insights could boost your portfolio and sharpen your instincts. Ready to get smarter with your money? Number 1. Timing the market. Trying to predict the perfect moment to buy or sell is a dangerous game. Warren Buffett advises that timing the market often causes investors to miss out on long-term growth. Markets are unpredictable in the short run, but historically, they've trended upward over time. Buffett suggests focusing on time in the market rather than trying to time it. Regular, consistent investing in solid companies pays off more than trying to guess the highs and lows. By staying invested, you benefit from compounding growth and avoid emotional decisions triggered by short-term swings. Patience trumps timing. Number 2. Getting attached to your purchasing price. Holding on to a stock just because you paid a specific price can cloud judgment. Buffett warns against emotional attachment to purchase prices. Just because you bought a stock at a high price doesn't mean it's still worth holding if the fundamentals change. Rather than clinging to past prices, focus on the company's current value and future prospects. Smart investing involves reassessing your position based on fresh information, not past costs. Don't let pride or regret hold you back from making objective decisions. If the outlook changes, adjust your position. Your entry price shouldn't drive your actions. Number 3. Aggressive growth projections. Assuming companies will grow at extraordinary rates leads to overpriced stocks and shattered expectations. Buffett cautions against relying on aggressive growth projections. When investors expect unsustainable annual growth, they often overpay and face disappointment. Buffett prefers companies with consistent, realistic earnings growth. Using conservative estimates gives you room for surprises and protects you if growth slows. Instead of betting on hype, look for businesses with steady results and clear competitive advantages. A reliable, modest growth path often beats risky, overhyped projections. Focus on tangible performance rather than optimistic promises. Number 4. Using a lot of leverage. Borrowed money might boost returns, but it also amplifies losses. Buffett warns that leverage can turn solid investments into disasters. When markets dip, leveraged positions may face margin calls or forced sales at the worst time. Buffett prefers investing with capital you own, not borrowed. Keeping control helps you weather downturns and avoid panic selling. Leverage introduces stress and reduces flexibility. Unless you have deep knowledge and risk control, avoid borrowing to invest. It's better to grow steadily and sleep well than chase high returns with high risk. Stability beats risk when you're leveraging your future. Number 5. Missing the forest for the trees. Getting lost in minutia while ignoring the bigger picture is a costly mistake. Buffett emphasizes focusing on the core business fundamentals: value, competitive edge, and leadership. Instead of obsessing over quarterly numbers or minor details, ask whether the company has a lasting advantage, a healthy balance sheet, and competent management. Strong fundamentals matter more than temporary fluctuation. Keep your focus on long-term viability and real-world performance. If you understand what drives revenue and profits, you'll make smarter choices. Don't let distractions derail your investment strategy. Look at the whole picture, not just the numbers. Number 6. Jumping over 7-foot bars. Buffett prefers simple investments in familiar businesses rather than complex ones he struggles to understand. He avoids 7-foot bars, investments requiring leaps into unknown territory. Instead, he walks over 1-foot bars, seeking straightforward, low-risk opportunities. If you don't understand how a company makes money, don't invest. Complexity invites mistakes and confusion. Staying within your circle of competence helps you make smarter, more confident decisions. You don't get extra credit for taking on complexity. Investing should bring clarity, not stress. Stick to simple, understandable businesses, and your odds for steady returns improve. Number 7. Shrinking your universe of opportunities. Limiting your investment options to familiar sectors or regions might close the door on potential winners. Buffett warns against over-narrow focus. While it's important to stay within your knowledge area, don't ignore opportunities just because they're outside your comfort zone. Explore various industries and regions, but only after doing proper research. A broad, informed view helps you spot value where others overlook it. Markets evolve and opportunities move. Staying open-minded increases your chances of finding hidden gems. Avoid blinkers, but don't go blind. Expand your horizons thoughtfully, and you'll uncover more investment possibilities. Number 8. Staying active all the time. Constant trading wears you down and eats into returns. Buffett believes the best investors often do nothing at all. If you believe in a company's fundamentals, holding long-term beats frequent adjustments. Every trade incurs fees, potential tax hits, and emotional strain. Instead, think like an owner. Invest thoroughly, then step back and let compounding work. Avoid the urge to tinker constantly. It's usually driven by anxiety, not strategy. Buffett's success with long-held investments proves patience pays. Learn when to act and when not to. Sometimes the smartest move is choosing not to move at all. Number 9. Diversifying too much. While diversification lowers risk, overdoing it can dilute your returns. Buffett calls it diversification, owning so many stocks that you lose track of them. He believes in concentrating on a few high-quality businesses you understand deeply. That way, you can manage them effectively and capture their full potential. Excessive diversification often stems from fear or indecision. If you've done your homework and trust your selections, owning fewer, stronger positions can outperform a scattered approach. Quality beats quantity. Focus your capital where your conviction is strongest and let it work harder for you. Number 10. Confirmation bias. Seeking only information that backs your beliefs is a common pitfall. Buffett warns that confirmation bias prevents objective analysis and causes you to overlook risks. Instead, play devil's advocate. Actively seek opposing views and challenge your assumptions. Discuss your ideas with critical friends or mentors to test your reasoning. The best investors aren't afraid of being wrong, they anticipate it. By welcoming criticism, you reduce blind spots and make more balanced decisions. Investing isn't about proving yourself, it's about finding the most valid assessment. Keep your mind open and your conclusions grounded in reality. Number 11. Following the herd. If everyone's chasing the same hot stock, it's often time to be cautious. Buffett says to be fearful when others are greedy, and vice versa. Herd behavior inflates prices and creates bubbles. When the tide turns, sentiment shifts, and many lose big. Buffett builds his wins by doing the opposite, buying quality when sentiment is low. Intelligent contrarianism requires courage and discipline. Don't let fear or euphoria lead your decisions. Analyze fundamentals, not social buzz. Going against the crowd, when backed by solid logic, can be highly profitable. Be thoughtful, not trend-driven, and you'll avoid costly mistakes. Number 12. Omissions. Failure to act can be as damaging as making a wrong move. Buffett admits that missing early investments in Amazon or Google cost him dearly. Called errors of omission, these lost opportunities quietly erode returns. The lesson? Be ready to act when a genuine, well-researched opportunity arises. Don't hesitate out of fear or indecision. Opportunities don't wait. Keep learning, stay alert, and trust your analysis. If everything checks out, act. Inaction can be a hidden risk in your portfolio. Great chances don't come often. When they do, be brave, informed, and decisive. Mistakes happen, but we can learn and grow from them. Buffett's 12 investing pitfalls offer powerful lessons for your portfolio. By recognizing and avoiding these, you set yourself up for long-term success and greater wealth. Which one surprised you most? Let us know in the comments below. If you found this video helpful and informative, please hit the like button, subscribe to our channel, and share your thoughts in the comments section below. Thank you.